This week, the Senate Banking Committee introduced a potential new regulatory framework for stablecoins. What's your biggest takeaway on that?
The stablecoin debate has been going on for a very long time, right? The first stablecoin was this thing called Tether that's still around. People use it all the time. The idea is that a stablecoin, it will always have the value of some stable asset, like a dollar or an ounce of gold or something like that. Tethered a piece of crypto to a dollar, right? But now it's not just Tether. There's a number of other stable coins out there, including Circle's effort, USDC, UST from Terra. There's a lot of these new efforts out there, and they have been regulated. They have been regulated, at least those in the U.S. since the beginning. Of course, that stands in contrast to the ones that have not been regulated outside of the U.S. But everything in the U.S., by and large, has been issued by something called a money transmitter, or some sort of financial services company that is regulated at the state and the federal level. So the federal level has always regulated stablecoins for anti-crime, so anti-money laundering, anti-counter-terrorist financing, that sort of thing. Then at the state level as well, a lot of these stablecoins are regulated as money transmitters. Money transmitter regulation focuses on safety and soundness, making sure that the person who puts the money in gets the money out. And so these things are regulated a lot like PayPal today, or Venmo, or MoneyGram, or Western Union, right? So these new efforts around regulating stable coins at the federal level for comprehensive regulation, these are new efforts. These are new, and frankly, they exist because Facebook came along and threatened to shake the table with something new, something called the DM currency. Facebook is famously, well, now Meta has famously backed away from that effort, right? And still, the questions remain. What it did was, it really did end up shaking the table. Now regulators at the federal level are really interested in putting together a comprehensive federal framework around stablecoin regulation. Senator Toomey on Senate Banking has introduced one attempt at that. We love to see it. We want to see those efforts. We want to see those efforts. We want to support those efforts, particularly those that are focused on growth for the ecosystem, right? The growth of the stablecoin ecosystem makes everybody better off. And we advocate at Kraken, we advocate for safe and sane regulatory environments that can produce commercially viable products that people want to use. And these regulations can do that. And particularly Senator Toomey has been a tremendous advocate for crypto broadly. I have high hopes for this effort.
You mentioned Terra, and we've been talking about Terra and UST and Luna obviously a lot for the last week. Is there any reason that the decentralized algorithmic ones would be regulated differently than the ones that we're familiar with, like Tether and USDC?
Yeah, I think there's plenty of reasons to regulate different products differently, because different products create different risks. So zooming out for a moment, there are asset-pegged stablecoins where there's some centralized party that is keeping one of those assets in reserve for every coin that circulates that's backed by that asset. On the other hand, there are the more exotic things that you're talking about now, like UST, where there's not a single asset of the same kind held in reserve to back that token that's circulating. Instead, there's this apparatus that exists on the blockchain, a smart contract that works to balance the value of that token against some other asset, like a dollar. And it uses other things that have value in order to do that, like, for example, in the case of Terra, a Bitcoin. Should those be regulated differently? Absolutely, absolutely. And the challenge is creating a regulatory regime that is elastic enough to cover both of those, or two separate regulatory regimes that can do those well, right? A regulatory regime that requires an asset to be held in reserve, on account, in full, for every single token that circulates might make sense for an asset-backed coin, because there are risks of loss, there are risks of abscondment, there are risks that those reserves just aren't going to be there at the end of the day when Joe or Jane wants his or her token redeemed, right? But for an algorithmic stablecoin, that relies on a very complex set of market-based algorithms that keep that coin at a particular value. The risks are different. The risks are the risks are more focused on smart contract auditing, cybersecurity, such that there won't be a rug pull, right? That's what the traders call what happens when the smart contract gets cleared out underneath you. Those are very different kinds of risks. They're cybersecurity risks that are attendant to these algorithmic stablecoins. You don't really have those in the same way for asset-backed stablecoins, because if the smart contract that monitors and administers the stablecoin for an asset-backed coin gets hacked or there's a flaw found in it, the assets are still there in reserve. That's different than an algorithmically pegged stablecoin, where the algorithm is itself the thing keeping the value stable. So we have been doing policy in crypto for a long time, and there's one of these basic tenets that is really held sacred among all good policy, whether here or abroad. Same risks, same regulation. Different risks, different regulation.
Moving on, SEC Chair Gensler made some comments earlier this week about regulating crypto. There have been a lot of mixed feelings in the community about his leadership. What did you make of his comments this week? What's your biggest takeaway?
So I think lots of folks in the crypto community have looked back on the last 10-ish years of crypto being a thing that normal people could interact with. It's been more than that, right, in terms of technology, but as a thing in commerce, it's been about a decade. Folks in crypto look back on that decade and see tremendous growth, tremendous success, with relatively limited losses over time, over the whole scheme of it. And they've also seen along that same timeline this obvious lack of government intervention. They say, wow, we've achieved so much as an ecosystem, as a technology, as a protocol, as a community, without the government stepping in. There's some skepticism anytime the government is going to try to step in. After all, why mess with a good thing? At least that's sort of the sense of the community. Realistically, though, there have been losses, and there have been good reasons even your most strident libertarian might look at what's happening and say, there might be a market failure here, and this is why we have regulators. Now, fast forward to today. Gary Gensler is in the chair at the SEC. Gary Gensler is a successful and aggressive regulator. Historically, he was the chairman of the CFTC and was successful and aggressive there. He did not sit on his hands there. Most folks who are close to this, looking closely at it and following it, maybe even trying to advocate and do good work in it, are going to see that the same thing is going to happen here with the SEC. The SEC is going to make its play in the crypto space. But the SEC is not the only player here. There is also the CFTC, which regulates commodity markets. And a lot of people around here will tell you that a lot of cryptocurrencies, a lot of digital assets more broadly, are not securities and have no place under SEC oversight. In fact, they're better placed under CFTC oversight. If you ask me, I cannot see a world, looking forward, I cannot see a world where only one of those regulators has complete jurisdiction over this space. This space is going to encompass so much. There are going to be so many assets that use a blockchain, that use decentralized protocols. To say everything is an investment, I mean, that's throwing the baby out with the bathwater. But to say everything is really just a commodity and these are all goods in commerce at every point in their life cycle, that's just Kool-Aid drinking, right? For a lot of these things, for a lot of these assets, I should say, there is an early stage where capital formation is taking place, where people are trying to raise money on the basis of their efforts. Not for all of them. Some of them start in different ways, but for a lot of them, investor-like protections make sense.
Right. Central bank digital currencies, another hot topic in Washington. Give us sort of the latest on where we are now on the regulation front there.
Yeah, central bank digital currencies are a big question, and they loom large, particularly for those who are also interested in stablecoins, right? Because the fundamental question for a lot of people is, well, gosh, why do we need a stablecoin if we've got a digital dollar or a digital euro or a digital yen, ruble in some circumstances, right? Why do we need a stablecoin if the government is going to provide us that? I think now, by and large, the tide in stablecoin discussion is moving toward the concept of a wholesale stablecoin. So there may be a privately issued, privately backed stablecoin like USDC or Terra, like we've been discussing, that you can access and hold in your wallet and trade back and forth just as you do today. But there might also be a central bank digital currency that could act as a stable coin, only not at the retail level, right? For sure, people have discussed a central bank digital currency in your pocket, but that's starting to fall out of fashion at the higher levels of discussion here because of the very real possibility that those dollars become the topic of political power, the topic of political controversy, so that the party in power, whether it's here or abroad, the party in power will be able to dictate if you have a retail CBDC, a retail central bank digital currency in your wallet. The government would be able to dictate what you can spend it on, how long you have to spend it, where you can save it, who you can lend it to, what the term of that loan could be, right? These would all become political questions. I think people react largely negatively to that. They see what goes on in Washington, they see what's going on in Brussels and London, pick your government. People by and large are skeptical that the government should have that much power over your day-to-day use of your own money. So that's really where the line gets drawn. It's the question of, do you believe that governments ought to be able to wield political power over the dollar bills in your wallet or not? Right now we live in a world where that doesn't happen. Do you want to live in a world where that does? Maybe you do.
So what's next this year? Because we kind of started off on a high note. It seems like investors reacted very positively to President Biden's executive order on crypto, but we've got that waiting period, that 6 months, where the relevant agencies go on their information finding mission. It's also an election year, so is there another big event, or is there another big thing in Washington that investors should be focusing on, or is it kind of a quiet year for regulation?
It's not going to be a quiet year for regulation. I think this year, particularly with the House up for grabs come November, we are going to see a lot happen behind the scenes. And so the smart participant in these markets is going to try to follow that. So that can dictate not only what is and is not legal, what you can and can't invest in, but the broader market structure, right? That's going to determine how people can even interact with their digital assets, how companies like Kraken can offer goods and services in the space. And if you're an investor in these protocols, it'll help to dictate what these protocols are and are not permitted to do legally. It'll help dictate what the platforms like us have to offer or are prohibited from offering our users. So this year is going to be a tremendous amount of activity, but I think it's going to be behind the scenes. I think regulators and policymakers in particular are going to be reluctant to make big bets in an election year, particularly on something like crypto. It's something that can help to define a policymaker's or a regulator's position on a very complex topic. A lot of politicians don't want to do that come November. They want to do it after November.
Is there anything in particular you are looking forward to seeing progress on behind the scenes this year?
Yeah, absolutely. I think this year we'll see a lot of progress on consensus toward a uniform secondary market regulation. So right now you've got all the different exchanges, Kraken.com being one of them. You go to Kraken.com and you can buy or sell a Bitcoin. You can go to our competitors and you can buy and sell a Bitcoin. We each do it a little bit differently, and that's part of what makes this industry so dynamic. But at some point, there's going to be a singular regulatory regime or a singular set of regulatory options that we're all going to have to choose from. This year, I look forward with my colleagues at other exchanges to setting up a uniform proposal or set of proposals that we can all operate under. Right now, Washington is hearing a whole cacophony of voices on this issue. They hear one proposal from one exchange, a different proposal from another. That's not how good policy gets made in Washington. So I look forward to sitting down with my colleagues and developing a proposal that we think is that's going to work for all of us, and presenting that to Washington and Brussels and London in a way that is going to make sense for our users and is going to allow us to offer them what they want.